All right, let's jump right in. In this breakdown, we're going to walk through a really interesting option strategy for SoFi, one that's built specifically around its upcoming earnings announcement. We'll explore how you can potentially use the market's own anticipation to your advantage.
So, let's start with a big question. How can you actually use market volatility to your advantage? Most of the time we see those big price swings as pure risk, but what if you could flip that on its head? What if you could actually harness that expected movement and turn it into a strategic opportunity? Well, that's exactly what we're going to look at today. Okay, so here's the setup. The opportunity really boils down to SoFi's upcoming earnings report and all the volatility that comes along for the ride. The market is basically telling us it expects a big move, and that creates a very specific set of conditions we can work with.
Now take a look at these numbers. As of early April, SoFi is trading around $15.85. The big day is April 29th. That's earnings. And here's the kicker. The market is pricing in a potential swing of almost $2 up or down. That's a huge move, over 12.5%.
So what's driving that big expectation? Well, it's a concept called implied volatility, or IV for short. You can think of it as the market's forecast for how much a stock is going to move. And right before a major event, like an earnings call, uncertainty is super high, so that IV tends to shoot way up.
And this is absolutely key. The strategy we're looking at is designed to do two things. First, take advantage of that high IV before the earnings news hits. And second, it also benefits from something called IV crush. That's the moment right after the report comes out when all that uncertainty vanishes and the high volatility just collapses.
So what's the actual tool we're going to use for this? Well, we're going to be looking at a specific options play known as the cash-secured put strategy.
Now, before we get into the nuts and bolts, it is so important to understand the primary goal here. This is not about a quick gamble. This is a strategy for someone who's already thinking, I wouldn't mind owning SoFi shares, and wants to find a way to potentially buy them for cheaper than they are today.
So what in the world is a cash-secured put? Let's break it down. You're essentially selling someone else the right to sell you SoFi stock at a price you choose beforehand. That's the strike price. For taking on that obligation, you get paid cash right up front. That's called the premium. And you secure the trade by setting aside the cash to buy those shares, just in case the price drops and you have to.
Okay, so that's the theory. Now let's get down to brass tacks. What are the specific actionable steps for putting on this SoFi trade according to the source material? This slide lays out the whole game plan. The asset, of course, is SoFi. The action is to sell a put option. The strike price we're targeting is $14. The expiration date is set for just after earnings, either May 1st or May 15th. And the goal is to get paid somewhere between 75 and 90 cents a share for making this trade. So, why $14? Was that number just pulled out of thin air? Not at all. It's a strategic choice. It targets a price that's about 12% below the current market price. And, more importantly, it lines up with a technical support level. That's an area on the chart where buyers have historically shown up to support the stock.
All right, and this brings us to the most crucial part, the so what. Let's walk through the two main ways this whole thing can play out once you're in the trade.
This slide really simplifies it. You've got two potential outcomes. On the left, if SoFi stays anywhere above $14, the put option you sold just expires worthless. You keep the entire premium you collected as pure profit, and you don't buy any stock. Easy enough. On the right, if SoFi drops below 14, you fulfill your end of the bargain. You get assigned and buy 100 shares per contract at that $14 price.
But here's where the real magic of the strategy comes into focus. If you do end up buying the shares, your effective price isn't even $14. It's this number, $13.15.
So how do we get there? Well, it's pretty simple math, actually. You take the $14 strike price, and you just subtract the premium you were paid right at the beginning. So if you collected an average of 85 cents, your true cost basis, your actual entry price for SoFi stock is $13.15. And that brings us to the final thought. See, this was about more than just a single trade on SoFi. It's about a whole mindset. So the real question to leave you with is this. Is using options as a tool, a way to define your exact entry price and lower your cost basis on stocks you already want to own, does that kind of strategy fit with your long-term investment goals? Something to think about. Thanks for tuning in.